A very good afternoon and warm welcome to all of you. I'm CA Dipti Jain from GyaanStation. Welcomes you all in today's webinar on navigating recent changes in buyback regime under Union Budget 2024. We are elated to share that GyaanStation is conducting this webinar jointly with Income Tax Bar Association, Ahmedabad, All Gujarat Federation of Tax Consultant, Goods and Service Tax Bar Association, and Tax Advocate Association of Gujarat. Here, I take the privilege to recognize the presence of our dignitaries in the panel. CA Santosh Doshi ji, the President of Jain Chartered Accountant Federation, Pune, CAIP Kailash ji Shah, Founder President of Jain Chartered Accountant Federation, Surat, our eminent speaker, CA Rushi Shah, and the recognize also the presence of the president of TAG, Jaideep Patel ji, Advocate Shailesh Makwana ji, Goods and Service Tax Bar Association, CA Ashish Tekwani ji, the immediate past president of ITBA, CA Dr. Vishwesh Shah ji from All Gujarat Federation of Tax Consultant, and CA Sridhar Shah ji from Income Tax Bar Association, and all the managing committee members of all this organization and all our participants. Welcome in today's session. Here, we conduct this webinars weekly from 4 to 5:30 p.m. with an object to update and brush up the knowledge of our professional brothers and sisters. In the busy life, we hardly find time to update ourselves. So weekly 1.5 hour at Knowledge Booster session at our platform will act as a confidence booster in your day-to-day professional routine. This in turn will help you to deal with your clients' requirement in an innovative way. We can proudly say that this is the 4th year of our EdTech platform, and we have received award for our educational courses for professionals at Bombay Stock Exchange also. Through GyaanStations, we are into online education, skill development programs, and we cater the professionals from diverse fields like CA, CS, CMA, advocates, HR trainings, MBAs, and many more. To watch all the webinars of GyaanStation, which is conducted jointly with all the other organizations, you can subscribe to our YouTube channel to watch the recordings for future reference. Now, I request the President, Advocate Shailesh Makwana ji from GSTBA to please welcome all our guests and participants. Over to you, Shailesh ji.
Yes. Good afternoon to all. Welcome to all of you. आज का अपने GyaanStation के साथ ये वेबिनार जो आज नेविगेटिंग चेंज इन बायबैक रिजीम थ्रू यूनियन बजट 24 का जो अलग सब्जेक्ट के ऊपर एक गुड सेमिनार जो जॉइंटली आज रखा है, जिसमें अपने अवर चीफ गेस्ट श्री संतोष जैन दोषी सर जी जो उपस्थित है, उसका अपने हार्दिक स्वागत करते हैं। उसके साथ अपने गेस्ट ऑफ ऑनर और ओपनिंग रिमार्क्स के आज के गेस्ट श्री एस कैलाश शाह सर जी अपने साथ है, उसका भी अपने हार्दिक स्वागत करते हैं और अभिवादन करते हैं। आज के अपने एमिनेंट स्पीकर श्री ऋषि शाह, इनकम टैक्स एक्सपर्ट जो उसके ज्ञान का अपने को लाभ मिलने वाला है, वो अभी अपने साथ है, उसका भी अपने हार्दिक स्वागत करते हैं। अपने साथ जुड़े हुए मेरे सभी ऑल ब्रदर्स एसोसिएशन के प्रेसिडेंट, सेक्रेटरी और जो इस GyaanStation में जुड़े हुए सभी मित्रों का मैं हार्दिक स्वागत करता हूं और अभिवादन करता हूं। और आगे की प्रोसीजर के लिए मैं दीप्ति बहन को माइक ऑन ओवर करता हूं। थैंक यू।
Thank you so much, sir. Pleasure to have you. Now I request our session chief guest, Santosh Doshi sir, for his words of wisdom. But before that, I would like to introduce him. Santosh sir is by profession, he is chartered accountant and business consultant. He is the director in Doshi Corporate Services Private Limited and CyberMate Forensics and Data Security Solutions Private Limited. He is FCA, DSAR, DIRM and PAPAD. and his core area of services lies in facilitating incentive subsidies to eligible units as supported by central or state government authorities for SMEs, delayed payments recovery from MSME Samadhan, project funding, debt syndication, management consultancy services. Other than this, he also provides digital services like digital forensic for financial forensics, investigation of cyber crimes, data breach, and incident response. As far as his social activities are concerned, Sir is chairman of JCF Pune chapter, chairman of Finance and Tax Committee of JSGIF MRC, trustee of Sujay Garden Jain Mandir, Pune. And he keeps on doing a lot of social and welfare activities. With these words, I welcome you, sir, in today's webinar. Over to you.
Thank you. Thank you. Thank you, Diptiji, for your kind words. Am I audible?
Yes, sir.
Yeah. So, dear friends, good afternoon. And special good afternoon to Kailash Bhai on his just birthday, which was on yesterday. So, as all of you know, that GyaanStation is conducting different type of seminars, as well as they are taking good issues which are contemporary as well as latest to the professional field. This is a good initiative that today we are going to learn about buyback shares related provisions which are stipulated in our Union Budget 2024. As we see through media reports that during last 6 months, from 1st January 24 to almost say before declaration of budget proposals, there are hardly more than 10 companies which were going into buyback of shares. But within last fortnight, there is a shoot of this number of companies to about 15 companies. We are now considering for going for buyback of shares. So this is really a good area to learn about. And obviously the steam is gathering in the market, because obviously up to 30th of September, the provisions are supposed to be complied with. And obviously I'm much more rather interested in looking as to how will it affect to private sector, public sector, as well as corporate entities, and what type of role can be played by a chartered accountant in this regard. So I wish all the best to all the learners in this session. And I'm also deeply thankful to Dipti Ben, that is GyaanStation, for giving me an opportunity to share my thoughts on the subject as a chief guest of the seminar. Thank you. Over to Dipti ji.
Thank you, sir, for devoting your time and your words of wisdom. And now I here take the honor to introduce today's guest of honor, CA Kailash Shah ji. Sir की जितनी तारीफ की जाए उतनी कम है. But let me shorten it with this, that sir is having 34 years of experience as a chartered accountant. And as on today, sir have handled 56 cases, highest for an individual in India having valid authorization in the field of IBC. He handled the first case of IBC of Ahmedabad NCLT in the year 2017, and he is currently working in Maharashtra, Ahmedabad, Delhi, and Hyderabad. He has till date resolved a dent amounting of rupees 1,18,569 lakhs through insolvency and bankruptcy code. He is currently conducting PhD study on recovery under the Recovery of Debts and Bankruptcy 1993 and SARFAESI Act 2000 versus Revolution under Insolvency and Bankruptcy Code 2016 from Bhagwan Mahavir College of Advanced Research, Bhagwan Mahavir University. He has been awarded by the Divya Bhaskar Media Group for excellence in MSME Sector 2024 for contribution in IBC matters, which he had recently received in last week. He has been awarded with this thing. And he is the co-opted committee member of ICAI on Insolvency and Valuation Standard Boards for the year 24-25. And he is the co-opted member of ICAI on IBC for the year 22-23. He is the founder president of JCF and founder treasurer of Jito Surat chapter. And he was the convener of Textile Market Surat CP Studies Circle of the WIRC and he has been speaker to various forums and seminars. So with these words, with high regards, sir, I welcome you in today's webinar. Thank you for being here. Over to you, sir.
Yeah, good afternoon, everybody. So, first of all, I would like to thank the Dipti ji and team GyaanStation for inviting me as guest of honor. So this year, as you all are aware that in this year's budget, Honorable Finance Minister has amended the income tax law on how to tax share buyback. The new law announced in the month of July will be effective from 1st of October 2024, and the new law tax the share buyback in a similar fashion as dividend are taxed now. The impact of this law amendment in this Income Tax Act relating to taxation of share buyback will be negative in most of the cases, but in certain cases, the taxpayer will gain as well. So, the effect of the change will take effect from October of 1st of 2024. So, according to the existing rules, the domestic companies undertaking share buyback are subject to a 20% tax on net distributable income, and the shareholders are receiving the buyback proceed tax free. So the company are paying the tax on distributable profit, and the shareholder the buyback receipt in the hand of shareholder is tax free. So which is similar to non-withdrawal now with already withdrawn dividend distribution tax, which was applicable up to March 2020. So now going forward, the money received from buyback will be taxable, completely taxable in the hand of the shareholder. So I am I am not taking much of your time, and I want to learn and hear the today's speaker, eminent speaker, C.A. Rasisa from Ahmedabad. Thank you once again, Dipti ji, for inviting me in this webinar. Thank you. Thank you very much.
Thank you, sir. And thank you to both our guests for giving their precious time to us and coming here and gracing all the participants with their words of wisdom. Now, coming to our today's session, we have Rushi here to enlighten us on this topic. So, here I introduce Rushi. So, Rushi is a fellow member of the Chartered Accountant. He holds silver medal in CA final and stood second all India rank in post-qualification diploma in international taxation. He also holds degree of MBA and LLB and has over 7 years of experience in the field, specialized in the knowledge and solution team leading with direct taxation, indirect taxation, transaction restructuring, and litigation services. He is regular speaker at various forums. So with these words, Rushi, I welcome you, and the dais is all yours. Over to you, Rushi.
Thank you. Thank you so much, the entire organization team and Dipti ji. I would like to first thank you, Kailash ji, Jaideep bhai, Shailesh bhai, Vishwas ji, Ashish ji, Santosh ji, and Sridhar ji for having this entire combined, the seminar. And I hope that I would be able to deliver on the expectation. And so to begin with, let me first share the screen of my presentation. I hope the screen is visible.
Yes.
Okay. So, Miss, every one of us might have heard the famous anecdote or the quote of Mr. Abraham Lincoln, saying that give me 6 hours to chop down a tree, and I will spend the first 4 hours sharpening the axe. And this is the same thing which we want to try to do today. as we are practicing, we are having a few of the corporate clients, and day in, day out, the corporate clients are struggling with the fact that the companies are earning income, but whenever they are having the distribution of the profits, then the distribution of the profits is taxable as dividend income. And we had the reject from DDT regime to taxability in the hands of the shareholders, and again DDT, and then again taxability in the hands of shareholder. So over a period of time, this reject, the change in the ecosystem, change in the rules have been observed. And in recent times, when we had Section 115 QA, which is dealing with the buyback of taxation of buyback. So normally, if you have observed that many of the large companies, including TCS, Infosys, etc., are having the buyback regularly. So once in a while, once in every year, TCS is having buyback of more than 15,000 crores, 16,000 crores in a year. So why they are doing the buyback? And what changes are proposed in this Union Budget 2024. So this is the entire topic for today. Probably we are not having so many slides to discuss as on date for today's session, but probably the interaction amongst the participants and their queries in between will help us to get into the depth of the subject. And so that whenever you are having any query, you feel free to post in the chat box, and then accordingly we will discuss. And if it is discussed later on in the later slides, then we will take it up accordingly. So to begin with, so today's session is we are first evaluating what is buyback. Second step would be to understand the present law of the buyback. Third step would be what changes are proposed in the present Union Budget 2024, and then what we can conclude in terms of what are the open issues, what are the concluded issues, what are the complexity involved in a buyback transaction. So that is the overall sense for the today's discussion. So as it is rightly discussed in the beginning by our guest speakers, Mr. Santosh Doshi sir and Kailash sir, in recent past, in last fortnight, after the union budget is announced, that there is flurry of the buybacks announced by the listed companies. The number of buybacks which are announced in last 15 days are more than the buyback announced in last 6 months. So why everyone is rushing for a buyback? And whether there is something which is, if we are not able to catch the train in time, whether there is a chance to miss out the train, or whether there is something which is, more beneficial before amendment, after amendment, that we need to look at. However, the recent flow of the buyback transactions, the announcements, are at least alarming enough for us as a practitioners to understand that if we can provide some solutions to our client, saying that before 30 September, if you are undertaking buyback, then it is good for you. And after 30 September, it may be not beneficial to you, or some options we can provide them, some options we can suggest to them. That is the overall understanding object for today. Now, first question is why we want to have a buyback? What is the commercial rationale? Why a company would undertake a buyback? So there could be different commercial rationales. First, there could be enhancement of EPS. So let's say there is a company, and normally how we understand EPS and P ratio in a listed company, that let's say if there are 1 lakh shares and there is 1 crore income, so per share earning is 100 rupees. Now, if the number of shares are reduced, then EPS will be increased. And assuming constant P ratio, the share price of the company would get inflated. Similarly, if a company is not in a business of capital intensive, and let's consider situation of IT companies. IT companies are not investing much in the assets, and that's why every time they are having the cash surplus. So if they are having cash surplus, so their return on the capital employed will be lower as compared to their peers. So and what a company would do with the excess cash? If they are not having investable opportunities, then they are normally expected, the board is normally expected to return the cash to the shareholders. So normally a buyback is also undertaken to return the excess cash to the shareholders in a form of a buyback. Then there can be a company which is doing very good in terms of their commercial business. However, the market price might not be commensurating with the their business expertise, and that's why the market price of the company share might be lower as compared to what it should have been. So to create a situation, or let's say the market price is 100 rupees, but now the company is announcing buyback at 150 rupees. So it will provide a perception to the shareholders or in the market that the company itself is envisaging the value of the share at 150 rupees. So 100 rupees is undervaluation, and that's why people will come to purchase the shares for the capital appreciation, and that will create a undervaluation perception in the eyes of the market. And the people will come and buy more shares, and it will increase the demand of the shares. Then the practical approach is for a smaller companies to have a buyback is to prevent hostile takeover. So let's say a company is driven by a promoter, and promoter is holding 45% shares. Now, someone they are identifying that there is one competitor, and the competitor is purchasing the shares from open market from third parties. And if the shares owned by the competitor will exceed a certain percentage, they will have the control over the company. So to avoid such sort of hostile takeover, the companies do the buyback. So they invite the shares from the open market from the third party, and accordingly, their the promoters' percentage will increase. So if we recollect, recently L&T did the hostile takeover of Mindtree, and we are having a few of other examples in which the hostile takeover was undertaken in the corporate sector. But just to avoid such a situation, promoters normally undertake a buyback. Then, as we discussed, to support the market price of shares, also the buyback is undertaken. Now, consider a situation of startup or closely held companies. So, let's say there is one company which is startup, and in the initial phase of the funding, they invited funding from third party, and now that third party is owning, let's say, 10% ownership interest in the startup company. They want to give exit to the this 10% shareholder. Now, what could be the different alternatives or opportunities to give the exit? One is that the existing promoter or existing director would or the existing shareholders would purchase the shares from the existing investor. But for that purpose, the existing investor has to cash out the funds, and probably he might not be having sufficient funds to acquire the additional stake, or probably he might not be interested into acquisition of the additional stake. So in that case, the funds which are available in the companies can be utilized for giving exit to the investor. So if the company is purchasing 10% of the shares in a form of a buyback from the exiting shareholder investor, then it will give exit to the shareholder without any further cash inflow by the remaining shareholders. So in such a situation of a startup or closely held companies also, the buyback is undertaken. Uh, the last thing is the tax efficient tool to extract funds from a cash cow company. So normally whenever a company is having or sitting a surplus funds, so normally if they are distributing the dividend is taxable in the hands of the shareholders. So normally the buyback is undertaken, and in such a situation, the company which is doing the buyback is supposed to pay taxes on such buyback transaction, and hence there is no tax implication in the hands of the promoters or the shareholders who are receiving the dividend income. So effectively, if you do the cost benefit analysis, there is a chance that the buyback may be more beneficial in terms of tax efficiency as compared to the dividend distribution. So this could be the different reasons why a buyback can be undertaken. Now consider a case study. X Limited has earned 10 CR during the financial year 2023-24, and Mr. X and Mrs. X are two promoters holding 50% each. Now Mr. X and Mrs. X want to extract funds for acquisition of a private villa, and they want to explore the options to extract the funds from the company, and then they are coming to you uh, to seek your professional advice what they are supposed to do to extract the funds at the least tax cost. So what could be the different alternatives to achieve this purpose? So first could be a loan from X Limited to Mr. X and Mrs. X. So take a loan from X Limited, and using the funds, borrowed funds, Mr. X and Mrs. X can purchase the private villa. The second alternative could be buyback of shares of Mr. X and Mrs. X, distributing an amount from the accumulated profits of the X Limited. So that could be the second alternative. Third alternative could be the capital reduction of shares held by Mr. X and Mrs. X. And fourth alternative is dividend distribution. Now, each alternate has a different tax consequence. Each alternate has a different legal consequence in terms of Companies Act provision, in terms of other provisions. So we need to understand and evaluate the pros and cons of each alternate from the perspective of Income Tax Act as well as Companies Act, along with the other laws, to evaluate first whether this alternate is possible or not, and second, if possible, what are the procedural requirement, and third is what is the tax consequence. So let's evaluate the tax consequence of these four alternatives. First alternate, loan from X Limited to Mr. and Mrs. X. So this transaction of a closely held company by way of distribution of a loan is taxable as dividend income in the hands of the recipient shareholder. So ultimately, to the extent of accumulated profit, it will be taxable as a dividend income in the hands of the shareholder, and the transaction would be subjected to TDS implication by X Limited. So it is at par with the dividend distribution, alternate D. If we compare alternate B, buyback of shares, for that purpose, we will refer to subsequent slides to understand the buyback consequences in greater detail. As far as alternate C is concerned, capital reduction. So capital reduction can have two consequences. One, dividend distribution as well as the capital gain implication. So as per section 222D of the Income Tax Act, when a company is undertaking a capital reduction, any distribution by a company to the shareholders to the extent of accumulated profit can be taxed as a dividend income in the hands of the shareholder. And if there is a remaining income, then it will be taxable as a capital gain income in the hands of the shareholders. But how to undertake a capital reduction? The capital reduction process is lengthier. It requires to comply with the requirement of the Companies Act, where someone means the company has to file the scheme before the NCLT. The NCLT will approve based on the consent of the stakeholders, including the creditors, shareholders, etc. And once the NCLT approves the capital reduction scheme, and then only the capital reduction would be taken place. So it is a little bit lengthy process. It is having the dividend and capital gain consequences. So it is complex as well as not tax efficient. And the last alternative is the dividend distribution. So normally the dividend distribution is taxable in the hands of the shareholder at the applicable rates in the hands of the shareholder. Now we are looking at the alternate number B, buyback. So first, what is buyback? So company may purchase its own shares or other specified securities from the shareholders. So normally the company cannot hold its own shares. However, as an exception, a company can undertake a buyback. And when the company is undertaking a buyback, it can purchase the shares or other specified securities from the security holders. So let's say TCS can purchase its own shares of TCS from the shareholders, right? So this is the buyback transaction. Now, how a buyback can be undertaken? So buyback can be undertaken through two modes. First, without NCLT approval, and second, with NCLT approval. When a company goes for buyback without NCLT approval under Section 68 of the Companies Act, they need to follow a procedure. The procedure may include board resolution as well as the shareholders resolution. So, but it will depend upon the facts of the case, the quantum of the buyback that we will discuss separately in the later slides. Secondly, the company can undertake the buyback through NCLT scheme. So, as a part of a scheme of compromise or arrangement under Section 230 of the Companies Act, company can have the buyback. But in such a situation also, the conditions of Section 68 are to be complied with. So the conditions under Section 68 are must to undertake a buyback. Then what are the source of buyback? Whether a company can have a buyback from any source? Answer is no. The law prescribes three sources of buyback. First is free reserve, second is securities premium, and third is proceeds of the issue of any share or a specified security. So if a company has free reserve or securities premium in the balance sheet, they can utilize such funds for the buyback purpose. And if the company does not have such funds, they can issue a share of specified securities at the first leg, and in the second leg, they can use such proceeds from issue of such share or specified security to undertake the buyback transaction. So out of these three resources, they can have the buyback, and then they accordingly distribute the funds to the shareholders. Now, what are the key conditions of buyback under Companies Act provision? So first, it should be authorized by the Articles of Association. Unless it is authorized by article, a company cannot undertake a buyback. Secondly, it should be supported by a board and or a special resolution. So when the company is undertaking a buyback to the tune of 10% of the paid up capital plus free reserve and surplus, in that situation, only board resolution would suffice. But if company wants to have a buyback beyond 10%, up to 25% of the free reserve and paid up capital, then a special resolution is must. And based on the special resolution only, the buyback process can be undertaken. Whether the buyback can be done in form by distributing property in kind, answer is no. The buyback can be done only by way of distribution of money in cash and not in kind. So let's say tomorrow there is one holding company and there is one 100% subsidiary company. The holding company wishes to do a buyback and they are planning to distribute the shares of subsidiary company as a distribution to the shareholders as a matter of buyback. Is it possible? Answer is no. Only the buyback in cash can be undertaken and not in kind. Subsequently, secondly, we are having the condition of maintaining debt equity ratio to the tune of 2:1. So after buyback, your debt equity ratio should not exceed 2:1. Whether the debt equity ratio has to be evaluated on standalone basis or on consolidated basis. So in past 2 to 3 years, there was a case of L&T, listed company Larsen & Toubro. Larsen & Toubro announced the buyback, and as a result of this, the standalone debt equity ratio was under 2:1 ratio. However, with respect to the consolidated debt equity ratio, it was more than 2:1 because the L&T group has L&T Finance, which is an NBFC company, so they are having a large amount of debt. So in that case, SEBI said that you cannot undertake the debt buyback because your debt equity ratio has to be checked from the perspective of the consolidated financial statement and not on standalone basis. And since on the consolidated basis it is exceeding 2:1, and hence the buyback was denied. So when a company is having subsidiary companies and associate companies, and when the company is supposed to have the consolidated financial statement, the debt equity ratio has to be looked at from the perspective of the consolidated financial statement. The next question is whether a company can buy back partly paid up shares. Answer is no. Only fully paid up share capital can be bought back by a company as a matter of buyback. Can a company have capital reduction of partly paid up share capital? Answer is yes. But as far as buyback is concerned, only fully paid up shares can be bought back. The next question is, let's say today a company has passed a board resolution or special resolution as per the requirement of the law. Is there any time limit to complete the buyback procedure? Answer is yes. The buyback should be completed within 12 months of passing a resolution. And is there any time lag between two buyback? So let's say today, if the company has a company had a buyback in December 2023, can company have a buyback today in, let's say, August 2024? Answer is no. There should be a time lag of at least 365 days between two buybacks. So no further buyback can be undertaken within a period of 365 days from the date of buyback. Now let's say if a buyback process is completed, then in a typical buyback, once the company announces the buyback, there will be a board or special resolution. Once the resolution is approved, company will announce the tender date. So during those days, the shareholders are supposed to tender their shares. And once the tender date is completed, the company will announce the ratio in which the shares are accepted, and the remaining shares will be given back to the shareholders. So once the consideration will be paid to the shareholders. So what is the time lag? And what the company is supposed to do with the shares which are tendered and accepted by the company as a matter of buyback? So company is supposed to extinguish the accepted shares within a period of 7 days from the completion of the buyback, and those shares will be extinguished by the company. So let's say once the company has done the buyback, can the company issue similar kind of securities? Yes. The companies are supposed to, companies are restricted from further issue of similar kind of securities. So within next 12 months, the company cannot issue the similar kind of securities further. So, so company can have issuance of similar shares and securities before buyback, but cannot have the similar issue of shares after buyback. So that this has to be kept in mind, just to ensure that the company is not running out of the money. And if you want to have the buyback, structure your buyback so that the company is having sufficient funds on hand, and you are also utilizing the buyback transaction in terms of the tax efficiency, as we will discuss in the later slide. Can company utilize the borrowed funds for buyback? Answer is no. Borrowed funds are used for the specific purposes. You can in the CARO reporting also, as a auditor, we are supposed to report that the funds which are borrowed are utilized for only specific purpose, and they are not misappropriated or misused for the different purposes. So buyback, as per the Companies Act requirement, you cannot utilize the borrowed fund for the buyback purposes. So these are the key conditions under the Companies Act 2013. Now let's look at the taxation impact before September 2024, as if there is no Union Budget 2024. Now, before 2024 or before Union Budget 2024, the buyback transactions are governed by Section 115 QA. So, if there is a transaction of buyback which takes place before 30 September 2024, the transaction would be governed under the existing provision of Section 115 QA. Now, what Section 115 QA says? As per Section 115 QA, and a company, a domestic company which is having the buyback will be liable to pay additional income tax on the distributed income on the buyback of shares from a shareholder. So basically, if a company is undertaking a buyback on the distributed income, the company would be liable to pay taxes on such distributed income. So whether 115QA is applicable only to a domestic company? Yes, it is only to domestic company. It is not applicable to the foreign company. Whether this provision is applicable to other entity? Answer is no. This is applicable only to a domestic company, and it is not applicable to other entities such as LP or partnership firm or any other structures. Now the question is, what is the distributed income? So distributed income can be computed as per the method provided under the Act. So the distributed income is nothing but a difference between the consideration paid by the company on the buyback of shares as reduced by the amount received by the company on the issue of such shares. So let's say the company has received 100 rupees when the shares were originally issued by the company, and now today company is undertaking the buyback at 1000 rupees. So difference between 1000 and 100, so net 900 rupees will be taxable as a distributed income, on which the company would be liable to pay taxes. Now the question is how to determine the amount received by the taxpayer. So let's say there could be issue of shares as a matter of bonus. There could be issue of shares as a first when the company was floated at a face value. There could be issue of shares at a securities premium. So how there could be issue of shares as a matter of sweat equity shares or ESOPs. So how to determine the amount received by the company? So the rule 40BB provides a mechanism to compute the amount received by the company in different scenarios. So when the company has issued shares for subscription, the amount received by the company, including the securities premium, would be considered as the amount received by the company in the computation of the distributed income. In the second scenario, where the company has issued the shares as a matter of ESOPs or sweat equity, the fair market value of such shares would be considered as the value received, and accordingly, the distributed income would be calculated. Then, in case of amalgamation and demerger, the amount received by the amalgamating company or demerged company should be considered. In case of conversion of preference shares, bonds, or debentures, the amount for which such instruments were issued. So let's say the company issued a preference shares at 100 rupees. Now the preference share was converted into equity shares, and the company is undertaking a buyback of such converted equity shares. Now, what should be considered as the amount received by the company? Because the company has issued the equity shares as a conversion of the preference shares. So in such a situation, the converted instrument, the preference share was issued at 100 rupees, and hence that those 100 rupees will be considered as the amount received on issue of such equity shares. Now, let's consider that the company is having 1 lakh equity shares, and the shares were issued at different tranches. First, a tranche of, let's say, 10,000 shares were issued at the time of floating of the company. Then subsequently the shares were issued with securities premium. Subsequently bonus shares were issued. Subsequently there was a variety issue of shares. So there could be the different tranches over a period of the entire life cycle of the company. So how to determine which shares you are purchasing, which shares are bought back as a matter of buyback? So the rule says that the value is to be identified on FIFO basis. So unless you cannot identify that these particular shares are bought back, you need to go back in the past. You need to identify which are the first shares issued by the company, and accordingly, the value will be derived on FIFO basis over a period of the company's life cycle. Next question is what is the tax rate applicable if the buyback is undertaken before September 2024? So as of now, under Section 115 QA, 20% tax rate is applicable, irrespective of whether the company is opting for 115 BAA, BAB, or other provisions. So 20% is flat rate, irrespective of the income of the company or irrespective of the regime under which the company is supposed to pay taxes on its own income. The 20% rate would be subjected to surcharge at 12%. The surcharge is normally applicable based on the total income of the taxpayer. However, as far as 115QA is concerned, the surcharge will be applicable irrespective of the amount of the buyback and irrespective of the total income of the company. So 12% would be applicable automatically. And similarly, says 4% will apply on the value of the tax rate as well as the surcharge. So effectively, this will result into 23.296% on the transaction value of the distributed income. So the distributed income as computed as per the guidelines will be subjected to 23.296 percentage of the tax rate. The question is, normally TDS are supposed to be paid within, let's say, 7 days from the end of the relevant month. But what is the timeline for the payment of 115 QA taxes? So the law provides that the taxes payable under 115 QA should be paid on or before 14 days from the payment of the buyback consideration. So once the company distributes the buyback consideration to the shareholder, within 14 days, the company is supposed to pay the taxes under 115 QA to the government. If the company fails to do it, the interest would be applicable. Now, as we discussed, there could be 4 mechanics for distribution of the amount from the company to the shareholders. So let's go back. So these are the 4 alternatives: loan, buyback, capital reduction, and dividend distribution. Let's understand what could be the tax implication under each of the 4 alternatives, so that we can have the comparative analysis that which alternative is useful or cost efficient before September 2024. And okay, so first situation is dividend or loan. Because the loan given by a company to the shareholders of a closely held company is equivalent to a dividend distribution under Section 222E, and hence the loan transaction would have the same implication as of the dividend transaction. Normally, the income is taxable in the hands of shareholders at maximum marginal rate, or as per the applicable tax rate in the hands of the shareholder. So let's assume that the shareholders are taxable at MMR because the shareholders are worthy enough, they are having a large amount of other income. So let's presume that the shareholders are normally taxable at MMR. So the MMR as applicable to dividend income would be 39%. And there will be tax consequence in the hands of company with respect to the TDS liability at 10% under Section 194. So the total tax liability on dividend transaction or loan transaction would be 39 rupees. So let's say if the company is distributing 100 rupees, 39 will be the tax liability, and the funds available in the hands of the shareholder would be only 61 rupees. 39 rupees goes to the coffers of the government. Again, if the shareholder is a company, then the benefit of Section 80M can be evaluated. But in our fact pattern, because it is not a corporate shareholder, so 80M would not be applicable. So as far as dividend and loan is concerned, 39 would be the tax consequences. Let's compare with the situation of the capital reduction first. So as we discussed, the capital reduction transaction to the extent of accumulated profit will be equivalent to a dividend distributed by a company, which will be taxable at 39%. And the remaining amount will be taxable as long-term or short-term capital gain based on Supreme Court judgment in case of M. Narasimhan. So it will depend upon what is the accumulated profit quantum, what is the period of holding, whether it is long term or short term in the hands of the shareholder, and accordingly the tax consequences will be determined. Let's presume that the amount distributed to the shareholder are lower than the accumulated profits, and the entire income is taxable as dividend income. So again, equivalent to our dividend situation, the company distributing the amount on capital reduction would be subjected to dividend TDS provisions at 10%, and the dividend would be taxable in the hands of shareholder at 39%. So effectively, the funds available in the hands of shareholder will be 61 rupees. As compared to that, if you look at the buyback situation, the buyback is taxable at 23.296%, as we discussed in the previous slide. And hence, if the company is distributing 100 rupees, and let's presume that the entire distribution is the distributed income, and there is no amount received, the shares were issued on bonus basis, so the entire value will be considered as a distributed income. In that situation, the entire transaction would be subjected to tax at 23.296%, and the funds which are available in the hands of shareholder will be 76.71%. So there is a arbitrage of 15% as compared to a dividend transaction or as compared to a capital reduction transaction. So that's why till now the companies were having the inclination towards the buyback, and today also the window is open up to 30th September 2024, and hence the transactions of buyback which takes place before 30th September would be governed by the old provisions of 115 QA, and they will be subjected to 23.296%. So this is a clear opportunity of having the tax arbitrage of 15%, depending upon depending upon the tax rate applicable in the hands of shareholders and other consequences. There could be some variations to this fact. Let's say the shareholder is non-resident person, and non-resident person is subjected to treaty benefit. So in those cases, the treaty may provide, let's say, 5% tax rate. Double tax avoidance agreement may provide 5%, 10% tax rate, which is beneficial to the shareholder. In that case, and let's say that non-resident shareholder is also eligible to claim the foreign tax credit in the foreign jurisdiction. In that case, probably buyback may not be useful under the existing provisions. Hence, it is very important to understand the profile of the shareholder who is receiving the dividend income, the profile of the company, to understand what is the balance of the accumulated profit, and to what extent it can be recognized as a dividend income, or to what extent it can be categorized as long-term capital gain, short-term capital gain, or other consequences in the hands of the shareholders as well as the company. So this is the overall impact analysis of a transaction or the alternatives through which you can have utilize as a shareholder the funds of a company. Now let's go to a situation after October 2024. So because the Finance Act 2024 provides the timeline of October 1, 2024, so it is very important to understand the condition of having the buyback before 30 September. So when a buyback is considered to have taken place, whether when the price is paid to the shareholder, when the shareholders are tendering the shares to the company, disclosing their interest in participation of the buyback, or when the shares are tendered and accepted by the company, right? So there could be the different events. So there is no clarity as on date that what is the exact event when the buyback can be said to have taken place. So when the process with the ROC is completed, when the price is paid to the shareholder. So instead of getting into this complexity, it is well advised that we can reach out to our client, saying that, see, there is a clear-cut exposure or the benefit of the buyback situation if the buyback is undertaken before 30 September 2024. And just to avoid this complexity, just to avoid the delay, and we are having many of the clients, which provide the data on the last moment, and then it gets into the consequences of filing a wrong return or incorrect return or missing out the deadline, and losing out the carry forward benefit of the losses. So instead of getting all these things, let's have a short discussion with the client in very in advance, to give them the understanding of the provisions of the buyback, the dividend provisions, and let's get their feedback whether this is useful for them or whether this is not useful for them. And if that is useful for them, then we can chalk out the timelines with the client well in advance, so that we are meeting the deadlines in time. So Now the question is, Rushi, having said that, or having understood that what is the consequence of the buyback before September 2024, what is the consequence if we fail to have the buyback before 30 September? Yes, let's go to the next slide. So as per the proposal of the finance bill, which is now accepted or passed by the Rajya Sabha as well as Lok Sabha, and it will be converted into act on presidential assent. So if there is an amount distributed by a company on a buyback, it will be distributed as dividend income. Now, the beauty of the provision is, if you look at the section 222, the dividend definition says that dividend includes, and then they are having clause A, B, C, D, E till date. And now clause F is inserted to give effect to the new amendment. Now clause A, B, C, D, and E, all these five clauses are dealing with the dividend only to the extent of accumulated profit. But now, if there is a buyback transaction, irrespective of accumulated profit, it will be taxable as dividend income. So there you don't need to look at what is the quantum of the accumulated profit and the amount distributed as a matter of buyback. The entire amount distributed to the buyback to the shareholder will be considered as a dividend income. Whether the benefit of the investment is available, answer is no. No deduction of any expenditure is allowed against such dividend income. So let's say the company, the shareholder has invested into shares of, let's say, Reliance at the price of 3,300, and then market was down and price was reduced to, let's say, 2,800. Tomorrow Reliance announces the buyback at, let's say, price of 3,200. So the cost was 3,300 and the buyback price is 3,200. And now the shareholder is frustrated and he wants to have the exit. So he is ready to tender the shares as a matter of buyback. So the shares are tendered, shares are accepted, and he is receiving 3,200 in his bank. Now, if you look at the commercial transaction, 3,300 was paid and he is receiving 3,200. So there is a net loss of 100 rupees. However, as per the new provisions dealing with the buyback, the entire 3,200 will be taxable as dividend income. And the tax rate will be depending upon the slab rate applicable to the shareholder. So now, if you look at the situation of individual shareholder, it can be as high as 39% as at MMR, maximum marginal rate. And so entire transaction would be taxable at 39%, even though in a situation where the shareholder is at net loss of 100 rupees. So that is the beauty of the transaction, that the provision is that irrespective of your cost, whether you have invested at the same price or much higher price, the transaction would be considered as a dividend income. And since it is a dividend income, the company which is distributing the proceeds on buyback is supposed to deduct TDS at 10%. So entire 3,200 will be subjected to TDS. So 10%, 320 rupees will be paid to the government, and net the shareholder will receive 2,980 rupees. So that is the tax implication as far as dividend is concerned. Now the question is, if as a shareholder I have invested 3,300 rupees, I am receiving 3,200, so net it is 100 rupees loss. Then if you are taxing me on 3,300 3,200 the dividend income, then what is the importance of this 3,300 of my cost of acquisition? Whether the entire cost of acquisition is now sunk cost and it will not get any deduction? Answer is no. The government has recognized the situation, and then they are saying that effectively your buyback transaction is nothing but transfer of a share, and transfer of share is nothing but a transaction of capital gain. So the buyback will be subjected to capital gain implication, but at one stage the income is taxable as dividend income, and at the second stage the government is saying that it will be subjected to capital gain. How? Section 46A of the Income Tax Act is amended to say that for the purpose of computation of capital gain on buyback, your net consideration shall be zero. It will be deemed to be zero. So entire amount received on buyback will be considered as dividend income. And as far as your capital gain mechanism is concerned, the net consideration will be considered as zero. And your origin means your cost of acquisition will be allowed as a deduction in the computation of your capital gain income. So if you typically compute your capital gain, your net consideration as reduced by your capital cost of acquisition or cost of improvement will be your resultant capital gain income. So your net consideration will be zero. Your cost of acquisition will be 3,300 in our example, and hence resultant loss of 3,300 would be allowed as a long-term capital gain or short-term capital gain depending upon the period of holding. Now the issue is, on one stage you are taxing my receipt on dividend income as a dividend income and the income from income from other sources, right? On the second stage, you are saying that the loss will be allowed under the head capital loss. However, the loss is not allowed to be set off against the dividend income. Hence, there is a situation that, let's say, in the year one, there was a buyback and there is the income taxable as a dividend income in the year one. But in year one, the shareholder does not have a capital income to be set off against the resultant capital loss on buyback. In that situation, the loss will be carried forward. Even though I incurred the loss of 100 rupees in the first year, still it will be subjected to it will be subjected to tax in the first year, and the loss will be carried forward for the remaining period, depending upon the provisions of law for carry forward of the losses. And unless you are having set gain which can be set off against such losses in future, you cannot utilize the loss and it can lapse. So this is the situation that at one stage you are taxing the income as dividend income. On the second stage, you are considering the transaction as a loss under the capital gain income. So same transaction is taxable under two heads. It has two implications under the income tax act. One income, one loss. Loss can be subjected to set off against similar losses. So if we are having the chart that the long-term capital gain loss can be set off against long-term capital gain. However, the long-term capital loss cannot be set off against the short-term capital gain. There is a restriction on set off. Similarly, any capital gain income or loss cannot be set off against any other head of income. So if the shareholder is having the short-term capital gain loss or long-term capital loss, it cannot be set off against the business income or it cannot be set off against the dividend income. So there can be a dichotomy. So in this situation, it is very important to understand that whether the shareholder is having a loss, if he is having a loss under the capital gain regime, under the capital gain regime with respect to the buyback. So whether the shareholder is having the capital gain income to be set off in the current year or not, and let's say in the current year there is no set of income to be set off, then it may result into the present value and the tax loss of the interest cost of the losses. Now going to the next slide. Now let's understand what is the rationale of the government when they have introduced the provision. What they are saying? They are saying that payouts on buyback of the share should be taxed in the hands of recipient in line with the taxation of dividend. So they want to equate the transaction with the dividend transaction, and that's why they are saying that the entire payouts on buyback should be considered as a dividend income. They are saying that both dividend as well as the buyback are the method for the company to distribute the accumulated reserves and thus ought to be treated similarly. However, as we discussed in the earlier slide, section 222 to E are referring to accumulated profit, but the taxability of the buyback is irrespective of the balance of the accumulated profit. So there is a dichotomy that in the memorandum, they are saying that if there is a distribution of the accumulated profit by way of dividend or buyback, they should be treated similarly. But when it comes to the provision of the law, they are saying that irrespective of the accumulated reserve, it will be taxable as a dividend income. So there is a dichotomy. Now, in this situation, let's say the company is not having accumulated profit, and they are distributing the amount on buyback. Can shareholder take a stand that let's look at the memorandum? Memorandum says that the dividend or buyback are a method of distribution of accumulated profit. Since we are not having accumulated profit, they should not be treated at par with the dividend income. Answer is no, because whenever we are reading the law, we need to go by the literal interpretation of law. If the literal interpretation of the law is ambiguous enough, then only we are supposed to refer to the memorandum. Otherwise, we will go by the letter and spirit of the wordings of the law only. So, since the law is very clear that irrespective of the accumulated reserves, the amount which is received on buyback will be treated as a dividend income. It should be treated as a dividend income, irrespective of the balance of the accumulated profit. So, there will be a dichotomy, and we need to accept the fact that even after the recommendations and responses of the stakeholders, still there is no change in the finance bill, and it is accepted without any amendments so far as this provision is concerned, and passed by the Lok Sabha and Rajya Sabha. So that will be the law of land after the presidential assent. Let's consider a case study. So till now we have understood that what are the conditions for buyback under the Companies Act provision. Second, what are the tax consequences if the buyback is undertaken before 30 September? What are the comparative situation of distributing the profits from the company, and what could be the tax consequences of each and every alternative? Then we have understood that what is the tax consequence if the buyback is undertaken before 30 September 2024 on or after 1st October. So let's have a case study to understand that because of the changes. Now let's say if the clients misses out the deadline of 30 September and they are having the buyback after on or after 1st October, then what could be the consequences? Let's understand. So have a case study. Mr. X has set up X Limited having a paid up capital of 10,000 shares of rupees 10 each. The shares were issued at a premium of rupees 40 each. So the total amount which was received was 50 rupees per share, and into 10,000 means total bank balance was 5 lakh rupees. Mr. X owns 9,900 shares, whereas Mrs. X owns 100 shares. The company does not have accumulated profit. So basically, for entire journey of the company life cycle, company has not undertaken any transaction, so there is no profit in the books of account of the company. Now, after 3 years, the company wishes to buy back 1,000 shares at a price of 30 rupees, and the balance sheet which appears before buyback and after buyback is as under. Before buyback, share capital 1 lakh rupees, securities premium 4 lakh rupees, total on the liability side 5 lakh rupees as compared to the asset in the bank balance 5 lakh rupees. After buyback, since they are distributing 1,000 shares, means 30 rupees for 1,000 shares, so it will be a payout of 30,000 rupees. So the share capital will be reduced to 90,000 rupees. Securities premium will be utilized to the extent of 20,000 rupees. So it will come down to 3,80,000 rupees. The bank balance would be 4,70,000 rupees. Now let's have a situation. Let's say if the transaction is happening before 30 September 2024. So the amount paid on buyback is 30,000 rupees. However, we need to tax the distributed income. And as we discussed in the earlier slide, the distributed income will be the difference between the amount paid by the company on buyback as reduced by the amount received by the company on issue of such shares, including securities premium. Because the shares were issued at 50 rupees securities, including 40 rupees of security premium per share. So the amount received by the company on the issue of share is 50,000 rupees, and hence the distributed income is negative. And since the negative distributed income is not having any tax implications, that's why we are considered nil as a distributed income, and that's why the tax consequences is nil. As per section 1034A of the Income Tax Act, the income which is distributed by the shareholder is exempt if it is distributed as a result of the buyback. So there will be no tax consequences in the hands of the shareholder. So your net tax liability will be nil. Now let's compare the situation of the buyback undertaken on or after 1st October 2024. The amount paid on buyback is 30,000 rupees, and since the entire transaction is considered as a dividend income and dividend payout, the company is supposed to deduct TDS at 10%. So net distribution to the shareholder will be 27,000 rupees. Now let's look from the perspective of the shareholder. The shareholder will be subjected to dividend implication to the tune of entire dividend entire distribution. So entire 30,000 will be considered as a dividend income. Let's presume that the shareholder is HNI, high net worth individual, and he is taxable at 39%. So the tax as applicable to the dividend income is 39%, and hence it is resulting into 11,700 tax consequence. The tax rate of the TDS will be available, so additional tax payable by the shareholder will be 8,700. Now, as we discussed, the buyback after 1st October 2024 will have two consequences: first, dividend, and second, capital gain. As far as capital gain is concerned, the net consideration will be deemed zero, and the cost of acquisition, the original cost, will be allowed as a cost of acquisition, and the long-term capital loss will be 50,000 rupees. Because the long-term capital loss is not allowed to be set off against the dividend income, so hence it will result into the tax liability of 11,700 on the dividend income in after 1st October 2024. So there could be different consequences. Let's say if here the amount of distributed income is changed, here let's say the quantum of the tax rate applicable to the shareholder is changed. Let's say it is a non-resident company which is shareholder, which is subjected to tax at 5% or without any tax implication under the treaty, then the consequences will change. So it will depend upon the dynamics of the company. Again, I am reiterating myself to emphasize on the fact that the taxability in the hands of the shareholder, the taxability in the hands of the company would be very important when we are framing and advising the scheme or the buyback proposal for our client. So there is no straight jacket formula to say that in all the situation after 1st October it will be adverse year situation. Rather, in case of a non-resident company which is eligible for the treaty benefit, it may be useful even for the company, because if the transaction is subjected to tax as buyback income under 105 QA, it may be subjected to tax at 23%. But if it is considered as a dividend income in the hands of non-resident taxpayer, this is subjected to tax at 5%. In that situation, it will be more beneficial for the shareholder to go with the dividend option under the new regime rather than old regime. So one has to have the cost benefit analysis to understand in the proper sense that what is more beneficial to the shareholder and company in totality. Now, having understood that there is some changes with respect to taxation of buyback before 30 September, after 30 September. But is there any other consequences related to buyback? Yes, there are other consequences. So the first consequences is let's say that the market value of the share is, let's say, 100 rupees, right? And the company is doing the buyback at, let's say, 90 rupees. Hypothetically, that the shareholders are agreeing to offer their shares and company is purchasing the shares. Now, the question is whether a provision of section 56 to 10 can be applied in the hands of a company on buyback of its own shares. So if we look at section 56 to 10, what 56 to 10 says? It says that the shareholder will be taxable in the hands of receipt of a property or sum of money without consideration or for inadequate consideration. And what is the property for the purpose of taxability of 56 to 10? So they are having the list of specified property under explanation to section 56 to 7, which lists out shares and securities. So if the shares and securities are received for a value which is lower than the fair market value as provided under Rule 11 UA, then the recipient of the shares or securities will be subjected to 56 to 10. Now the question is, when the company purchases its own shares, whether it constitutes a property in the hands of the shareholder, in the hands of the company. Answer is no. The company is not supposed to hold the shares beyond a period of 7 days. Within 7 days, the company is supposed to destroy and extinguish such share certificate which are accepted as a matter of buyback. So it can never become a property of company. So let's say shares of Reliance Limited. Can Reliance say that its own shares are property for Reliance? Answer is no. Shares of Reliance is liability for Reliance and it is not a property of Reliance, right? So it can never become a property and capital asset of company itself, which is having the buyback. So that's why it is never a situation of applicability of 56 to 10. But however, one should be cautious enough because department may trigger 56 to 10 as a matter of litigation and it may result into prolonged litigation. But in my view, 56 to 10 should not apply in case of a buyback by company. The next question is there any valuation guidelines under the Income Tax Act as applicable to buyback? Let's say the fair market value of the share is 100 rupees. The company wants to undertake a buyback at, let's say, 1,000 rupees on upper side, or in a reverse situation, let's say at 10 rupees on lower side. Is it permissible? Answer is no. Yes, there is no valuation guidelines as applicable under the Income Tax Act provision. So the buyback can be undertaken at any price under the Income Tax Act. So as far as your section 50C is concerned, it is not applicable. 11 UA guidelines is not applicable. So the company is free to decide the valuation for the purpose of buyback as far as the income tax provisions are concerned. So under income tax provision, there is no guidelines as such as far as the buyback is concerned. Now there are few open issues under the proposed buyback regime, and these are very alarming issues, and I request all of you to pay kind attention because I am not discussing everything in detail on this slide because there are various open issues. There could be view 1, view 2, view 3, and view 4 also. So let's have some discussion with open mindset without going into whether view 1 is correct or not. But let's have some fruitful discussion to understand the perspective. The first question is whether a taxation of a buyback as a dividend is constitutionally valid or not. Because as per the constitution, the central government has right to tax only income. and the income when the company is distributing the dividend and the transaction is recognized as dividend. What is the dividend? Dividend is taxable only to the extent of the accumulated profit. Beyond accumulated profit, there cannot be a dividend at all, right? In the normal sense. So the question is when the government is saying under section 222F that the amount distributed on buyback is to be considered as dividend, then whether it is going beyond the constitutional validity. Of course, constitutional validity is not my cup of tea to discuss. It is the matter of expertise, and only a senior counsel, senior advocates can advise on this aspect. But just to have some fruitful discussion, just to get the understanding. And one more thing, let's say so far as section 222 is concerned, we always consider that, let's say 222E, 222D, etc. are deemed provision. They are deemed dividend. But if you look at 222 minutely, section 222 never uses the word deemed. So it is not per se deeming fiction. So when you are having deeming fiction, probably there can be argument that this transaction is recognized or it is deemed to be income for the purpose of Income Tax Act, and hence for the purpose of constitutional validity also it should be considered as income. But so far as 222F or 222 entire section is concerned, they are not using the word deemed. So in absence of deeming fiction, in absence of a reference to accumulated profit, whether someone can challenge the provisions of buyback. We had one discussion with one of the senior counsel, and he opened that challenging a provision so far as income tax is concerned on the constitutional validity is very difficult task, and he advised that one should avoid getting into the constitutional validity. Agreed. So one should not get into the complexity of the constitutional validity because it may be subject matter of the writ petitions or SLP before the High Courts and Supreme Court. But one should be open in mind whenever there is some arguments to be developed before the department as a matter of litigation. One may explore it. The second question is, let's say if there is no accumulated profit in the balance sheet of the company, can still there be a dividend implication? So far as the provisions are concerned, provisions are clear. 222F, the new provision says that the amount distributed on the buyback is to be treated as dividend income. So irrespective of the accumulated profit, it will be treated as a dividend income. So on this aspect, there can be some alternate thoughts, but to my understanding, so far as literal interpretation is concerned, in my humble opinion, it should be considered as a dividend income. The next argument is, or next question is, whether the amount taxable as dividend requires to be deducted against subsequent dividend distribution. So let me give some example. Let's say when a company is distributing, giving a loan to the shareholder, so normally it is taxable under 222E so far as it is a closely held company, and it is taxable only to the extent of accumulated profit. And so consider situation first step loan distribution, and second step is the buyback transaction. So loan to the extent of accumulated profit, it will be a dividend income, and second transaction buyback of shares, it will be dividend income irrespective of the balance of the accumulated profit. So both leg, first leg loan, second leg buyback would be considered as a dividend income in the hands of the shareholder. Now let's flip the situation. Instead of having loan as a step one, let's have the buyback as step one. So step one buyback and second loan as a step two. So as far as buyback is concerned, irrespective of the accumulated profit, it is to be recognized as a dividend income. When you come to step number two, loan transaction, loan is taxable as dividend income only to the extent of accumulated profit. Let's say in the balance sheet, the accumulated profit was 100 rupees, and the company is already distributed at 120 rupees as a buyback. So if you are reducing the value of the buyback from the balance of accumulated profit, there is negative balance of the accumulated profit. So can the taxpayer, the company or the shareholder take argument? Let's look at the balance sheet. The 100 rupees accumulated profit, the entire accumulated profits are distributed as dividend in step one, and hence there is no balance of accumulated profit so as to tax the loan transaction. Is it possible or is it not? So far as the provision is concerned, since the buyback is not linked with the accumulated profit, probably one may take a stand that, or the department may take a stand that, see, you are not supposed to link the buyback transaction with the dividend transaction or the accumulated profits, and hence you are not supposed to reduce the accumulated profit to the extent of buyback proceeds. However, it will be fair argument to say that only the accumulated profits are taxable and the balance of the amount which is attributable from the the buyback distribution should be adjusted. Hence, one has to evaluate such a situation. In my humble view, one may explore it. Whether it will be favorable or not, I don't know. I'm not sure about it because the law is new, law is emerging. There will be further development. So only the courts and tribunals will decide. But one may evaluate different situations, try to identify different loopholes, different situations where one can explore the benefits of the law. Probably, I would not say a loophole in loose sense because something may be intentional by the government itself. Because if something is not linked with the accumulated profit, so probably there is intention of the government also that it has to be adjusted. So one has to evaluate it, and ultimately the courts will decide. The next question is whether the distribution of buyback consideration is taxable in India as, let's say, dividend, but whether the same characterization of dividend income would be applicable under tax treaty. So let's say a person is investing in Indian shares and he is resident of Singapore. So when he is receiving an income from India, so he will always look at India-Singapore treaty subjected to availability of TRC, tax residency certificate. He is looking at the treaty and he's identifying the applicable article. He's looking at the article number 10, which is dealing with the dividend income. He's looking at the capital gain income. He's looking at the other source of income, other income article. Now the question is whether when the domestic law of India says that the buyback distribution is dividend income, whether the same principles can be adopted for the tax treaty, or can you have the different interpretation for the tax treaty? So whether the characterization under the domestic law is sacrosanct for the tax treaty also, or you can have a different interpretation for the tax treaty. So normally, most of the treaties define the dividend to say that any income from the shares or corporate rights or any other rights, which is subjected to the same taxation treatment as the income from shares by the laws of the state of the which company making distribution is resident. So the treaty will direct you to come back to the domestic law of a company of a country in which the company is resident. So let's say Indian company is distributing the amount on a buyback. So then you are supposed to come back to India to look at whether the Indian domestic law treats this transaction as income from shares or income from other corporate rights. If yes, then it will be have a tax implication of dividend characterization under the treaty also. But the question is when there is a buyback, whether it is income from corporate rights or income from shares or income from alienation of shares. So just to give a perspective, let's say there is an immovable property. So any income by way of rental of immovable property is considered as income from immovable property under Article 6 or 7 of the treaties. But if there is a transfer of immovable property, it is considered to be capital gain transaction taxable under Article 13 of the treaty. So if you are holding the immovable property, you are earning rental income, it is subjected to different tax implication. And if you are transferring the immovable property by way of alienation, in that case, it will be subjected to capital gain articles. In our case, in case of buyback, when the shares are transferred, the shares are extinguished by way of tendering the shares and the company accepting the shares. So in that case, there is a alienation of shares. So in that case, whether it is the characterization of dividend income or it is characterization of the capital gain income. So this is the very crucial aspect one has to understand and evaluate as far as the non-resident shareholder is concerned. So these are the some of the tax consequences which are very important as far as one is looking at the buyback scheme when we are proposing to the shareholder or our clients that you should go ahead with the buyback, but wait for a moment. You need to understand the profile, have a detailed profile of the shareholder, just understand what are the different nuances surrounding his financial, what are the other incomes, what are the other capital gain incomes, what is the tax rate applicable to the shareholder. Accordingly, in totality, one has to decide whether one should go ahead with the buyback or not at the first stage. Second stage, whether one should go ahead with the buyback before 30th September or after 30th September. And when, let's say, once you decide you are having a rigorous meeting with the client and you are convincing the client that you should go ahead with the buyback before 30th September, then also you need to provide a timeline, detailed timeline along with the SOP, along with the requirements of the company law to say that, this buyback process will take at least 25-30 days. Even if we are expediting, the requirement of issuance of the notice to the shareholders for 15 days, 7 days, and so on. So all these steps, even though they are curtailed, the shorter notice are ratified by the shareholders, then also it will take at least 15-20 days to complete the process. And I would suggest that if we are planning to undertake a buyback before 30 September, try to complete the entire process, including the ROC filings, etc., before 30 September, so that there is no controversy whether the buyback has taken place before 30 September or after 30 September. Let's not get into it, because all this litigation will, gets its own journey. It will take a lot of time before the courts. It will be a pain for the shareholder company, as well as to us also, in case of defending the client. So let's have a clean balance sheet by way of having a clear understanding of the client's profile, and have a buyback if it is in the interest of the shareholder and the client. So this is the overall understanding of the buyback regime before amendment, after amendment, and these are the open issues which we need to consider in the mind whenever we are framing the buyback transaction. So that's it from my side, and I would like to invite the if we are having any questions around the buyback situation.
Thank you, Rishi, for this wonderful presentation. We have a few questions in the chat box. You can go through that. So I'll read the question for you.
Yeah.
This question from Mr. Santosh
Hmm.
Sharma is the tax paid by the company will be disallowed for income tax purpose?
Normally, if you look at the income tax provision, and as far as your deduction, as far as your PGBP income is concerned, profits and gains from business and profession, they are saying that if the taxes are payable or rates are payable with reference to your tax income, then it is not normally not allowed under Section 48. All right. So there is a controversy whether the amount which is paid on buyback can be allowed as a deduction or not. If you look at the Section 115 QA, 115 QA says additional income tax. Similar, that was the same situation for the DDT also, dividend distribution tax, when the company was supposed to pay taxes on the dividend distribution. So if you look at the genesis, ideally, if someone goes by the conservative view, people should avoid taking the deduction unless the client is aggressive enough to take the call. As far as my personal thought is concerned, my opinion is concerned, it should not see. If you look at Section 37, so you are having one enabling provision to grant the deduction, and second the disabling provision which are restricting certain deductions. If you look at Section 37 and Section 28, they are saying that if any expenditure is incurred for the purpose of business, then it will be allowed. So we are having in past some judicial precedents to say that if the company is undertaking some other corporate restructurings, let's say amalgamation, demerger, etc., whether it is allowed as a deduction or not, the courts are kind enough to allow the deduction. Now it is a subsumed under 35D, of course. But as far as the buyback is concerned, and the amount which you are paying is not normal expenditure. Let's say in buyback, there is a consultant fee. Consultant fee should be allowed to you. But as far as the income tax is concerned under 115 QA, the department will always go to challenge it, because the transaction or the tax which you are paying is in the nature of income tax, and income tax by its nomenclature itself will be disallowed and subjected to litigation by the department. So I would suggest that all other expenditure in relation to the buyback should be allowed, but as far as the income tax is concerned, probably it would be difficult to take a stand that it is allowable.
Okay, fine. And the next question is, before that, I want to make an important announcement. On
Yeah.
21st of August, we are coming up with a very important webinar on tax audit. And for that, we are having CANC Hegde sir. He is the partner of Deloitte and handling international taxation and the direct tax matters at Deloitte, Mumbai. So don't miss that insightful session. We will share the registration link soon. And that registration link will be shared by all the organization, and the chairman of the session is CA BM Agrawal sir, the past chairman of WIRC, is going to join us on 21st of this August. So here's an important announcement. So do book your timing for the same. The time is going to be between 5 to 7:30, looking at the office hours. So kindly block your calendars for that important tax audit session by CA NC Hegde sir. He is also the past Central Council member and the partner of Deloitte. So let's go back to our question and answers. The next question, Rushi, is can we buy back the share on fair value or book value or issue price or even less than all the above value tax implications? on the
As
same?
far as the income tax provisions are concerned, there is no restriction. But one has to look at the Companies Act provision. So far as I recollect, there is a restriction that you cannot undertake a buyback at a price lower than the face value of the shares. So that one has to evaluate. But so far as income tax is concerned, there would not be any tax consequences as far as your pricing is related. So there will not be any implication of Section 50 CA or 50D, etc. Because all these provisions are applicable as far as there is a transaction under capital gain regime. Let's say after 1st October 2024, when your transaction is subjected to capital gain implication. So Section 46A says that your net consideration will be deemed nil. As compared to that, Section 50CA may provide a different computation mechanism. There will be a controversy between applicability of 50CA as well as Section 46A. I would say that since 46A is specific provision, it is a deeming provision. In that sense, Section 46A should prevail over 50CA, and accordingly, 50CA etc. should not have any consequence as far as the buyback is concerned, even after 1st October 2024.
Okay, fine. The next question is, can we buy back the share on fair value or book value or issue price or even less than all
I think
the
this is
above
the
value
same.
tax? Yeah, we have taken this. Now the last question of the session under old regime up to 30th September for buyback case. In case of company, it is taxable under section 115 QA and in the hands of shareholder. There are two provisions exist, one in under section 46A, which makes it taxable, and other is under section 10, subsection 34, which is exempted. So which section prevails for the taxation in the hands of shareholder up to 30th September?
So
Again, you have, yeah, please.
So since the buyback is taxable under Section 115 QA, we are having provision under Section 1034A to say that the transactions which are referred as buyback under Section 115 QA shall be exempt income. So
Okay.
far as income is exempt, then there is no requirement to go, up to the computation provisions. So the provision of Section 46A, which is in a way that computation provision or charging provision should not apply. So I would say that if there is, let's say, exempt income, then you would not travel up to section 45, 46 to understand that whether there is a charging mechanism applicable or not, whether there is a computation mechanism applicable or not. So since the income is exempt under section 46, under section 10, the provision of section 46 will not, 46A would not apply. The question could be, let's say, if you are saying that in case of buyback, 46A does not apply, then what is the relevance of 46A? Then by way of that interpretation, you are making the provisions redundant. However, let's look at 46A. 46A refers to buyback of any security. Let me just go through. 46 says that where a shareholder or holder of other specified securities. And then they are defining the word specified securities as per the meaning of section 77A of the Companies Act. Now, 1956. Now, if you look at this interpretation of specified security, there can be ESOP also. So if the company is, let's say company has distributed ESOPs and company is purchasing back the ESOPs, then they are not shares, they are rights in shares, they are options. In that case, 115 QA will not apply, 46A will apply. So before 30th September also, the 46A provisions are not redundant, that they are applicable, but they are applicable in very restricted sense, and hence in a situation of buyback of shares by company before 30th September, only section 10 will apply as an exempt income and 46 will not operate.
You're muted, Dipti.
Yeah, now I request CA Sridhar Shahji, the President of Income Tax Bar Association Ahmedabad, to please give vote of thanks. And after that, we
Dipti
have
ji,
some special moment
just
for
1
our
minute.
birthday person who is with us.
Yeah, just
Yes,
1 minute.
Roshi ji.
Yes,
Yes, Roshi ji.
yes.
I would like to request all of the participants, all of the panelists to, give a positive, means feedback, constructive feedback, so that if you are having any queries regarding the buyback, you can reach out to me. And as well as, means if you are having any feedback with respect to the topic, deliverables, etc., you can also reach out to me with your constructive feedback so that I can also improvise. Thank you.
Thank you,
Over
Rushi.
to you, Sridhar ji.
It was wonderful
Yes.
presentation. Sridhar ji, please.
Thank you. Thank you, first of all, Rushi, for being available on such short time. And when time was running against the after the budget came, I remember our conversation about the buyback and how it will affect. And we can see the research we have done by combining all the laws, especially the Companies Act and Income Tax Act, when it comes to interplay of both the acts. So thank you for delivering on such a nice and wonderful lecture, and thank you participants for being here on such a specialized subject. Still, we had a good participation strength. So thank you all the participants. And on behalf of GyaanStation, Income Tax Bar Association, I thank all the associations for being part of this platform on regular basis so that we can reach to maximum people and we can spread the word more. I also request all the participants and all the associations to share this idea with their social media handles also, so that we can have maximum reach. And knowledge has no boundaries, and we can prove that knowledge has no boundaries. Everyone from India can join on this station, and that should be our goal. Thank you once again, and thank you, Rushi, for such a excellent lecture. And I'm sure you will get messages and mails from people once your PPT